I'm going to be showing you guys how to trade institutional candles. This is going to be part 3 of the institutional candle series. This is actually the last part. So if you haven't watched part 1, you definitely need to go and watch that, because that's like the intro to institutional candles. And then if you haven't watched part 2, you definitely need to go and watch that, because we go over market flow. And we know that if you trade in line with the trend, you win more of your trade. So definitely watch part 2 as well. So in part 3 of the institutional candle series, I'm going to be showing you guys how to trade institutional candles. So right now we are on a 4-hour time frame, but nobody enters, or no one should be entering on a 4-hour time frame. There's no way. Why? If you ever enter the trade off of the 4-hour time frame, your stop loss is going to be absolutely huge. Let me just quickly show you something. These institutional candles are so large. Check this out. From that high to this low, we're talking about 143 pips. I think it was like a year and a half ago, I was just watching another video on Forex, and they were talking about using a 140 or 120 pip stop loss. I said to myself, God forbid, man, this is absolutely crazy. Going for like a 1 to 4, like, guys, this is nuts. This is crazy. And you know, whether it works for them, that's good for them. I know that stuff does not work for me. You don't want to be trading off of that high time frame. You want to get your bias from the higher time frame and then zoom on over to the lower time frames to get an entry. You can even go to the 1 minute time frame to actually trade, because you can get tighter entries like that. But what I'm going to do today is I'm going to go ahead to the 5 minute time frame to show you how you can trade these institutional candles. We're in that portion of price when price is basically distributed at the top. If you watch part 1 and part 2, you know exactly where we are on GU right now. So we're in that little section over there. And so now when we look at this last up close candle, you're also going to get other smaller time frame institutional candles as well. So you're going to get last up close candles within last up close candles. And so now check this out. When you zoom in, as you can see here, so you have to ask yourself, what is price doing in this area over here? Price is basically respecting this area. Okay, so to retail traders, they're going to be thinking this is some kind of strong zone, this is some kind of resistance or something like that. But as traders who trade with the institutional concepts, with smart money concepts, we know that these highs are going to get run out. And so look what they do. They run out liquidity with a last up close candle. This is what happens when price constantly taps a specific area multiple times. Eventually, there's going to be some kind of manipulation to the highs. Okay, some kind of running out of stop losses, running out of liquidity. And you guys know what happens again. They run out of stop losses, they activate buy stops, and they also run them out. And so what you need to do to catch an entry with this is when price breaks beneath that last up close candle, that institutional candle, you can see what happens. Price breaks beneath it here. Okay, breaks beneath it. This is the low to beat. They break beneath it. You want to be catching an entry when they return back to this last up close candle, because they're only returning back up to this last up close candle over here. Let me zoom in a bit more. They're only returning back to it, this last up close candle, to mitigate their position, to close out their drawdown trade. So there's, you know, other ways to find out how to enter in there towards the high. This is not what that video is about. That's also what I share with my mentees. So if you're down for that, hit me up on Instagram. My Instagram is at MHU_FX, and then we can get to work on that. But what you want to be doing is you want to be trying to catch an entry when price returns back up to this last up close candle. This whole move, this upward push. One more time, I know you're going to be saying, okay, cool, but there's multiple candles here. But it's not about the number of candles. It's about what the intentions are from this upward push. The intentions were to run out liquidity. In doing so, they bought before they sold. Then draw down in these orders here. And so when they return back up into this last up close candle, this is where you want to be jumping into your trade. You can either enter at the open. I'm just going to simplify it, just really simplify this. The open, yeah, or 50%. The open or 50%. And so if I was just to bring out this little fib tool here like that, okay? So this is what you want to do. You either want to enter at the open when price returns back to this up close candle, and as you can see, it returned back a few times just to mitigate, or 50%. Price is not always going to get up to 50%. I don't want to be the one person that tells you that it's always going to get there. No, it's not. So this is why potentially it will be good to have 2 potential orders. With all of this, you're going to have to do this in your demo account. I want you back testing this. I don't even want you to be touching this on a live account. I want you to back test this and see this for yourself. And then once you come to a conclusion, then go forth and start doing what you want to do. This is literally just showing you guys how to trade institutional candles, and I want you guys to be doing this on your demo accounts. I just want you to be able to see this for yourself. It's within this up close candle, that's going to be the best place to catch an entry, anywhere within this. And obviously you can go down to the 1 minute time frame. If you go over to the 1 minute time frame, you're going to get an even tighter entry. Just a quick interruption in the video. If you are getting value from this video, definitely subscribe to the channel. Let's get this channel to 20,000 subscribers in 2 weeks. Also, don't forget to smash that thumbs up button. Let's try and get this video to 400 likes. And the safest place to place your stop loss, the safest place, I'm giving you the safest place to place your stop loss, is above the last up close candle. That is the best place to place your stop loss. The best place to place your stop loss. One more time, they break beneath the institutional candle, violating it. They return back to it to mitigate their positions. Some people like to enter at the open. Some people like to enter at 50%. When you enter at 50%, you might potentially miss the trade, but then obviously you get a much better R. But you make that decision. The safest place to place your stop loss would be above the last up close candle, because they shouldn't come back up here again, because they've already taken the liquidity up here. They've already violated these highs, taken the liquidity, run the stop losses. There's no reason for them to come back up here again, unless the trend was actually going up. And then you can take TP to whatever point you would like to take TP. You can take it to the bottom of the last up close candle. You can take it to a specific area, some type of liquidity, whether it's equal lows, whether it's a low, or whether you have a higher time frame bias, you can TP out there too. So that's one example. Let's move on to another example. We're looking at this portion of price action, this downward move here. Okay, just so you know, in case you missed it. Moving on to the next up close candle now. What's happening here? You get another last up close candle within a last up close candle. Once again, I said you can refine it. You're going to find more institutional candles within institutional candles. We're on the 50-minute time frame here. I'm going to go to the 5-minute time frame. Now in the 50-minute, it was less candles. On the 5-minute is even more candles. But basically what I'm trying to get you guys to understand is not about the number of candles. It's about the intentions of that push, which was to run out liquidity. Within this last up close candle, you're also going to get another last up close candle. And so what you would do is you know where the open is, which is down here, and you know where 50% is. This is basically normally the only time I bring out the Fibonacci, just to mark up 50% of this area here. This is the last up close candle. As you can see, price breaks beneath the last up close candle, and turns back to the open of the candlestick. And so if you're that person who's looking to enter the trade off of the open, don't forget the safest place, okay, the safest place to put your stop loss would be above the last up close candle. And then you'll be targeting some kind of money, some kind of liquidity. You can see there's equal lows here. We could have partialed out when you took equal lows. You could have done that. But the ultimate goal is for it to continue to break beneath this last down close candle. There was also more equal lows down here, as you can see. Equal lows down here as well. Right here, boom. Well, technically there was triple lows. There was triple lows down here, actually. Triple lows, equal lows, like that. These could have been your target points. Down here, all these equal lows and, triple lows you can see here. Equal lows, boom. You can see equal lows down here. You can see triple lows down here. These would have been your target point. So this is why when it returned back up to the last up close candle, you're not panicking. You're not stressing, especially if there's equal lows. Especially if you know that on a lower time frame is on a downtrend, you know that price needs to break beneath this last down close candle to stay bearish, And so this is why you could potentially target the last down close candle or some form of liquidity. In this case, it was triple lows here, there was equal lows here. And so, like I said, the safest place to place your stop loss would be above the high. And as you can see, look, price came up again to mitigate again, digging deeper into that last up close candle, and then price dropped. Don't be afraid, man, to have a trade at the open and a trade at 50%. You can enter anywhere within this last up close candle. So not everyone's going to enter here. Some people might enter when it digs a bit deeper into this. Some people might be looking for something else within this move to enter off of that. So you're seeing it one more time over here as well. Last up close candle within the last up close candle. We've got liquidity along the way. These can be your target points. You could have partialed here, took off more down here. Safest place to place your stop loss would be above the high. This is that same downward price action again that we saw in GU, but I wanted to show you some more. So now check this out. You got a high over here. You got a last up close candle that runs out liquidity. All these highs get taken out with this upward push. Anyone who's trying to sell GU from here, any of these areas down here, this move up would have taken out your stop loss. So when price breaks beneath the last up close candle, which it did right here, when it returns back to it, this is where you want to be catching your trade. But then the entry that I actually caught on this trade, and I share the trades that I'm in on Instagram on MHU_FX on Instagram. So if you're not following me there, definitely go and follow me on Instagram, MHU_FX, for my Forex related content. Last up close candle, you mark up the last up close candle like this. And this is where the people who enter in off of that 50% of the last up close candle, this is where they would have caught their nice little move. And this would have been the big move, the big push down. The safest place to put your stop loss, if this was you, would be above this up close candle. And in this case, this would have been like a nice juicy trade. Your stop loss could have been about an 8 pip stop loss, okay, an 8 pip stop loss, and you would have caught a good amount of R. Even if you had targeted, let me just go for short 50% trade, boom, it was an 8 pip stop loss, okay, boom, something like that, 8 pip stop loss just at the highs, and you targeted the bottom of the last down close candle, that would have been a nice 1 to 6 still. You would have caught roughly about 56, 57 pips, and you would have been laughing. That would have been a blessed trade. And just because it comes back to it more than once, don't be afraid. It would return back up there to mitigate even more. But eventually, price would then push away from that last up close candle, and then you catch your move. This would have been a nice lucrative trade that you could have taken at the 50% of that last up close candle and then dropped. Beautiful trade. So now this is the final one I want to take you through. Price is created some highs over here. Okay, there's a high, there's some highs, there's all these highs as well. They've run out the highs, as you can see, run out all the early sellers, run out those buy stops as well when they drag price back down into the range. They break beneath the low of that last up close candle. The best place to enter would be when price returns back to this last up close candle. So anywhere within this last up close candle, the best place to place your stop loss would be above the last up close candle. And so once again, some people like to enter at the open, which is down here. Some people like to enter at 50%, which is right here. And as you can see, what happens, price trades into this area, trades into this 50% area, and then drops. So the person who entered in at the open, if they placed their stop loss correctly, they still would have had a winning trade. The person that entered in at 50%, once again, if they had placed their stop loss correctly, which is at above the last up close candle, you still would have had a beautiful winning trade. This is how you trade institutional candles. You're going to be seeing them on the higher time frames, but don't just trade off of that higher time frame. You get your bias from the higher time frames, but zoom on over to the lower time frames to see whether you can refine those trades. That's one thing I show my mentees. You know, I'm all about refining those trades and catching the smallest stop loss possible to maximize your return. And so if you want to know about that, holla at me on Instagram. My Instagram is at MHU_FX. MHU_FX. Yes, there's a new one right now. I do have a main Instagram, which is Harrison Uwa. You can follow me on that too if you want to. Thank you guys for rolling with me with this 3-part series on institutional candles. If you did like it, drop a comment down below and let me know you did. And let me know that you want to see more of these types of videos, and I will get them out to you. For the mentorship giveaway, which is the second mentorship giveaway in the series, the special word is going to be, the special sentence is going to be actually, not the word, the special sentence is like the banks. Like the banks, like the banks. That's all it is. Drop me a DM on my Instagram, MHU_FX, and just type in like the banks. Anyway guys, thank you guys for watching the video. Don't forget to subscribe to the channel. This channel's goal is 50,000 subscribers by the end of 2021. And also family, you guys know I like my likes. I'm talking about 400 likes in this video. I know the like gang can get that easy. Anyway family, thank you guys for watching the video. Have a blessed day. Peace.